Hello and welcome to Mission Wealth's Market Perspectives for the first quarter of 2019. My name is Kieran Osborne and I'm the Chief Investment Officer at Mission Wealth. I'm pleased to be presenting to you our outlook and update on financial markets today. This presentation will cover three key themes. Firstly, we'll take a look at 2018 in review. We'll cover the three major concerns that have been dominating headlines in the market for the last 12 months. That is, that the Fed has raised rates too fast, too soon, the trade war, and the economy. And lastly, we'll cover investment implications of the current environment. With the exception of cash, all major asset classes were challenged in 2018. The concerns surrounding the Fed raising rates too fast particularly weighed on bonds, which ended the year flat. Those concerns, along with the trade war and economic growth concerns, really peaked in the fourth quarter, which saw a spike in volatility and a global equity market sell-off. However, we believe recent increases in volatility are a natural byproduct of a transition towards a more normal market environment, not reliant on extremely easy central bank and Fed policies. The major concerns affecting markets over the last 12 months have been that the Fed has been raising rates too quickly, the ongoing trade war, particularly with China, as well as some economic growth concerns. Turning to the Fed, if we look at the Fed's dual mandates of price stability and full employment, they are currently providing little pressure on the Fed to raise rates. So we may be approaching normalization on that front. With that said, the Fed's policy is going to be data dependent, and some other issues may affect and guide policy, such as the outcome of the trade war. Speaking of the trade war, US-China trade negotiation headlines may continue to provide near-term volatility, but we do think something will ultimately get done. The timing of such a resolution, however, remains unclear, but we do think it is in the interests of both sides to come to some form of resolution. In terms of the economy, economic growth is still above trend, but likely to slow throughout 2019. We believe oil price weakness will be a net positive and stimulative. It's essentially acts as a tax cut for consumers, though the recent government shutdown has not helped. So what are the investment implications of this backdrop? Well, global equities finished 2018 at very attractive levels relative to historic averages. And we don't think that the recent sell-off was driven by a material change in underlying fundamentals. We believe that as we transition towards a more normal volatility environment, this may provide greater rebalancing opportunities, greater opportunities to buy low and sell high. Any trade resolution with China will likely benefit international and emerging markets in particular. And we are closely monitoring Fed policy and yields, which may be approaching normalization. As this chart clearly depicts, all major asset classes were challenged in 2018. In fact, it was the first time in over 35 years that cash was the top performing asset class. The Fed raised rates faster than anticipated, which led to some bond price weakness for much of 2018. In fact, the Fed raised rates 4 times. For some context here, at the beginning of 2018, the market only anticipated 2 rate rises from the Fed. As a result, the 10-year Treasury moved from 2.41 to a high of 3.24% before ending the year at 2.68. These two charts here depict the S&P 500 throughout 2018, as well as the most commonly followed fear index, the VIX index. The top chart clearly depicts that equities experienced weakness in the fourth quarter in particular. So what drove this uptick in market volatility? Well, the three dominant concerns were that the Fed was raising rates too quickly, too soon, the ongoing trade war with China, and economic growth concerns, which all came to a head in the fourth quarter and drove this market sell-off. However, we also believe that the recent uptick in volatility is a natural byproduct of transitioning towards a more normal environment, not reliant on easy monetary policies. Said another way, the Fed's extremely easy policies in response to the great financial crisis have acted as a tailwind for stocks. Now that proverbial punch bowl is being taken away, it is only natural for us to return to more normal levels of volatility. Indeed, while it didn't feel like it with the uptick in volatility, 2018 was actually a decidedly average volatility year. This chart's a nice one. It depicts the long-term averages in terms of daily price moves on the S&P 500. And you can see across every metric, 2018 was right in line with averages. It didn't feel like it was an average year because we've had such contained volatility over recent years. And in fact, 2017 was an abnormal year in terms of volatility. We experienced almost no volatility in 2017. Very, very unusual. So what does a normal stock market look like? Well, in any given year, you can expect an average intra-year decline of 14%. Note, however, that 3/4 of the time that the stock market ends that same year positive. A normal year, you can expect 1 minus 10% sell-off, 5 minus 5% sell-offs, and multiple plus or minus 2% daily moves in the S&P 500. Now, with this uptick in volatility, we do not think a return to more normal levels of volatility is necessarily a bad thing. In fact, a healthy functioning market needs a natural release valve. However, we believe a return to more normal levels of volatility may reward our disciplined long-term approach to portfolio construction and rebalancing. Our long-term expected returns across asset classes have not changed meaningfully. We just anticipate there may be more bumps along the road, but these bumps may provide for increased opportunities to buy low and sell high, and ultimately add value over the long haul. So let's take a look at the three major concerns that have dominated headlines: the Fed, the trade war, and the economy. Firstly, with the Fed, let's take a look at the Fed's two dual mandates, that of price stability or inflation and full employment. In terms of inflation pressures are largely held in check currently, partially as a result of recent oil price weakness, and we do not anticipate any substantial inflationary pressure near term. This chart depicts the unemployment rate over time, and you can see it has trended down, and it is gradually trending lower over time. At the same time, wage price pressure is below historic averages, so we're not really experiencing much pressure on that front either. So we don't believe there is much pressure for the Fed to raise rates from its dual mandates currently. And as this chart depicts, we are approaching the Fed's long-run equilibrium level for interest rates, as depicted in the above chart by the dot plot. The market anticipates one more rate hike in 2019 before the Fed may actually start cutting rates. However, we believe the Fed's decision will be data dependent. And there are some implications from the government shutdown on that data dependency. Because of the shutdown, a lot of these economic data points have been delayed, which may force the Fed to sit on its hands somewhat. Also, if we get some form of trade resolution, the ultimate economic impact of that may also help guide Fed policy going forward. So it's an area we are closely monitoring. Speaking of the trade war, will something get done between the US and China? We think yes. We think ultimately something will get done because it's in the interests of both sides, and there is a lot of pressure on both sides to get something done. In China, they've already experienced real economic and stock market impacts. The Chinese economy is driven to a large degree by exports and global trade, so any negative impact on either of those is going to have a negative, and has had a negative impact on the Chinese economy. Stocks here in the US came under significant pressure in the fourth quarter as investors digested the potential negative earnings impact for US companies. And the reality is, if Trump wants to be re-elected, getting a deal done with China may help that re-election bid. Ultimately, we may end up with some politically palatable resolution for both sides. However, the timing of which still remains unclear, but trade negotiation headlines are likely to cause ongoing market volatility until resolved. Turning to the economy, while it feels like we've been in the late stage of the economic expansion for some time, if we look at key economic fundamentals, they indicate we are really just entering the late cycle now, with growth still above trend. As this chart depicts, we believe growth peaked in 2018, but we still remain at above trend levels, both relative to the current expansion average of 2.3% and the long-term average of 2.7%. There is little inflationary pressures affecting the economy, and indeed, recent oil price weakness is stimulative for the economy. It essentially acts as a tax cut for consumers. We do not anticipate a recession in the near term. However, we do see that there may be some overhang and implications from the recent government shutdown. While we got a short-term reprieve on this front, there still remains some uncertainty. US company earnings were extremely strong in 2018, as depicted in this chart above. However, the challenge in 2019 may be that we are cycling these very, very high comps. Now, we do anticipate still solid earnings, but more in the mid-single digit range. So it will be interesting to see how the market digests. Still solid, but nowhere near the level of strength that we experienced in 2018. Obviously, a large part driven by the implications of tax reform. So with this backdrop, what are the investment implications? Well, global equities finished 2018 at very attractive levels relative to historic averages. And we don't believe the fourth quarter sell-off was driven by a material change in fundamentals. Rather, the economy is still above trend, albeit slowing. Our long-term expected return across equity classes remains positive. While historically speaking, this may be a relatively favorable time to be an equity market investor. As I said earlier, we do not anticipate a near-term recession. So if we are 1 year or 2 years out from the beginning of the next recession, historically speaking, that has tended to be a fairly favorable time to be a stock market investor. We do see some near-term risks. The government shutdown, again, we got some positive news the other day, but yet some uncertainty still remains. Brexit, it may cause some uncertainty within Europe. And then the trade war, while we believe something will ultimately get done, the timing of which still remains unclear. Again, our long-term expected returns across asset classes have not changed. We believe equities will continue to offer attractive long-term return potential. And while we are transitioning towards a more normal volatility regime, that more normal volatility may reward well-constructed, broadly diversified portfolios and provide for greater rebalancing opportunities, taking a disciplined approach to rebalancing, stripping out emotions from that investment decision, which forces us to buy low and sell high, and ultimately may add value over the long haul. Any form of trade resolution with China may benefit international and emerging market stocks in particular, because these countries are much more reliant on global trade and exports as a primary driver of their underlying economies. We are watching interest rates and Fed policy very closely, which may be approaching more normal levels. However, we do believe that the Fed's policy will be data dependent, and also dependent on the outcome of the trade war. So that data dependency is a function of the government shutdown, again, may cause the Fed to sit on its hands for some time, watching that situation very closely. Staying fully invested is key. Don't allow emotions to dictate investment decisions. This chart highlights the importance of this. We know equity market sell-offs are usually followed by very strong rebounds in large daily moves in the stock market. If you sold out and missed the market's 10 best days, you would give up nearly 5% of annual returns. If you missed the market's 20 best days, you would give up nearly 8% annually. Again, staying fully invested is key. So with all that, what actions are we taking here at Mission Wealth? Well, for one, stay diversified. Do not let emotions dictate investment decisions. Rather, we believe our disciplined long-term approach to portfolio construction and rebalancing may add value over time, particularly as we transition to a more normal volatility environment, one which allows us to increasingly buy low and sell high and add value over the long haul. We continue to favor a globally diversified allocation to equities. Global equities are currently trading at attractive discounts relative to historic averages and may offer compelling long-term return potential. We are managing our interest rate sensitivity closely within core fixed income, maintaining a slightly shorter duration exposure than the broad fixed income market. We have already reduced our credit exposure given the late stage of the economic expansion we find ourselves in. Ultimately, we believe our portfolios are well positioned for the forthcoming period, offering a globally diversified portfolio that may weather the potential for ongoing market volatility, a rising interest rate environment, and the ever-changing geopolitical and economic landscape. Thank you very much. As always, should you have any questions, please don't hesitate to contact your client advisor.